Okay, so today we are talking about two different ETFs and we're starting with SPYG. It's down 26.89% so far year to date, so it's down quite a bit so far, and this is actually the SPDR Portfolio S&P 500 Growth ETF. We're going to be comparing this to SPYV, another similar ETF from the same fund company, and this one's down so far for the year 6.12%, so actually much better than SPYG. So this is going to be an interesting video, I think. And by the way, this is called the SPDR Portfolio S&P 500 Value ETF. Before we begin, I want to make sure you have a framework for understanding like why I'm even talking about this, where this would actually fit in for myself, how I think that you should, frame this thing. I'm going to do this real quick, okay? I have this is how I allocate money into the market. I call it the Jack of all trades portfolio. 35% of my money goes into stocks. 25% goes into this thing called barometer. It's a rules-based strategy. You could call it a quantitative strategy where I buy individual stocks. So these are all stocks. Over here now, I have I basically recreate the S&P 500 with the sectors I like, and I use ETFs for that. Then I have miscellaneous strategies where it would be ETFs oftentimes. So I'll throw in here is where I would maybe say, do I like SPYG or do I like SPYV? So that's what I would do. I would be in this area here. And so I might have high conviction. I might like the sector or the style. We're talking about styles today. We're talking about growth or value or hedging downside or something like that. And then I have cash, okay? So when I talk about something like this, it would be in this context, this 10% of the portfolio that I have. For you, it could be totally different, right? So maybe you want to actually put most of your money into one of these. Maybe you want to put, a larger portion into one of these. This is up to you. This is just, I want to make sure you understand my framework. And of course, by the way, these are the brokers I'm using. They all have SIPC insurance. So unlike a lot of brokers maybe that you have crypto in these days, if you do, you probably don't have those protections, right? So make sure that if you're investing in some type of broker, you have some type of protections, okay? Let's get to the video. All right, so here we go. We're on the Charles Schwab ETF comparison tool, SPYG on the left, SPYV on the right. Let's talk about these. So of course, one is growth, one's value. These are different ways of looking at investing. Maybe you like one or the other, maybe you like both. We're gonna talk about that in this video. So let's say SPYG has a net expense ratio of 0.04%. Very cheap, okay? Doesn't get much cheaper than this. Then SPYV has an expense ratio of 0.04% as well. Also, so very similar, okay? Very cheap funds, great. I've actually had quite a few comments from people lately that want to know the actual price of these ETFs, and I understand that because if you have a high price ETF, it might be hard for you to invest in it. So, okay, here you go. SPYG, $53 and SPYV, $39. They're not high, it's not a lot of money to invest in these ETFs. Great. So if you're into investing in ETFs that have a lower price, that's good for you. If you don't have a ton of money to put in, that's good for you. So all right, let's talk about yields. Some of you might be into dividend investing. Some of you may be into more growth type of investing. So let's talk about the yield here. So the SPYG, of course, doesn't have much yield, 0.92%. You're not buying this for the yield. That's not the reason you would get this. SPYV, for example, does have good yield, 2.20%. Not crazy high, but definitely in the area of maybe what you would expect. And by the way, if you hear weird animal noises in this video, I live in the Philippines. So we got dogs barking outside on the street. We got roosters for the people next door. Okay, I'm sorry about that. I can't do anything about it. Let's talk about the portfolio here. So the SPDR S&P 500 Growth ETF has $12.8 billion in assets. SPYV, 13. So they're similar, right? Not a big difference here. Now, what's interesting here is 245 holdings are in SPYG and 448 holdings are in SPYV. Now, what's kind of very interesting to me is that the S&P 500, this only invests in S&P 500 companies. So there's 500 stocks in the S&P 500 index. Now, 448 of those stocks are actually considered in the value fund right now. And, the other part here is growth, 245, so much less growth, right? And since the market's been down, maybe that has something to do with it. Maybe it's interest rate. Now let's talk about how they define the stocks that go into these portfolios. So for the value, SPYV, we measure value stocks using three factors. So we have the ratios of book value, earnings, and sales to price, okay? So these are the general ratios that they're going to be relying on to find stocks that they consider to be value stocks. And so apparently 400 something stocks fit these criteria, right? And so that's why they're going into this portfolio. Okay, let's take a look at growth. Growth, we measure growth stocks using three factors. So also three factors, but they're different factors. Sales growth, the ratio of earnings change to price, and momentum. So there you go. Now, there may actually be fund overlap here, which you would not think, but there is. So let's talk about that real quick. So here we're asking the question of what the overlap is between SPYG and SPYV, okay? So there's 103 overlapping holdings. 75.9% of SPYG's 242 holdings are also in SPYV. So a lot of the holdings that are in SPYG are also in SPYV. Now, we know SPYV is larger, so there's a lower amount that overlap there. 41.2% of SPYV's holdings are also in SPYG. Now, we're talking here about how many individual stocks, but when we talk about weighting, it's different because the larger the company, the higher the weight in these portfolios. And that's where it does get to the point where, the general weight, which is it is the most important part here, is not that big. So there's 27% overlap. Meaning that, for example, if Apple was in both of these funds, that would be a pretty big company because Apple is the largest company that is in the stock market, right? And it would be the largest holding inside these two. And so basically what I'm just trying to tell you is that they're based on market cap. So the larger the company, the more weight, and there's not as much overlap based on weight, which is the most important, really. If we want to take a look at the drift, so how much is in, let's say, SPYG, it has more tech, okay? This is how much more tech it has, 33.6%. It has consumer discretionary. It has more communication services, which, for example, Google falls under communication services, and I believe Facebook or Meta as well. And then on the other side, we have more value indexes. So we have real estate, materials, healthcare, which maybe could be growth or value usually. Utilities, of course, energy, financial services, industrials, and staples. Okay, let's hop back real quick to see the top 10 holdings. So Apple is the number one in SPYG. We got Berkshire Hathaway, Warren Buffett's company in SPYV. Now on to the part that everyone loves to see, which is the returns. We have a chart, SPYG versus SPYV. SPYV is white, okay? SPYG is black. A lot of people, they go back and they say, okay, which one's outperformed over the past 5 years? Which one's outperformed the past 10 years? I don't really do that in these videos. I try to go a little bit further, of course, and talk about what we really think in general based on economic, what's going on in the economy. Now, the reason this doesn't always look correct is, okay, first off, if you had bought SPYV over back in October of the year 2000, you have more money if you invested in the value portion. Now, that's weird because everyone probably thinks growth would have done better because growth has done so well recently. And we always have recency bias, and that's the thing. Let's go to the 5 years. Okay, which one did better? Of course, the growth did better. SPYG did better. But how do we really decide that? Because if we go back here and we take a look at 2001, let's say in November of the year 2000 actually, and we go until November of 2010, obviously value did much better. Growth is negative 37%. Value is up 21%. Huge spread, right? Okay, well, what do you do here? There's not just one way to look at this. Of course, investing is very complicated and there's many different layers and dimensions to it. But let's throw the federal funds rate on here. If we're looking at more recent times and the federal funds rate, you could see here, there's a giant spike in the interest rates, right, that the Fed is setting, and that's not good for growth stocks generally, okay? And as you can see, right when it starts, which is when inflation is starting to become a very, very sticky situation for the Federal Reserve, they have to start increasing interest rates. What happens to growth stock? They plummet. Well, value stocks, they go down, but they don't go down as much because interest rates are worse for growth stocks generally than value stocks. And so that's a big question you might want to ask yourself. Do you think that the Fed funds rate, do you think the Fed is going to keep fighting inflation for a long time? Is that going to help value stocks more than growth stocks over, let's say, the near term? Long term, do you think that there's a big problem? Or do you think that growth stocks will be fine because maybe the Fed's going to, they're going to succeed in battling inflation pretty soon and they'll go back down, interest rates will go back down, maybe growth stocks come back. Now you might say, hey, Robbie, what do you think? Well, if I'm going to take a total guess, my thought is that growth is going to be better over a very long-term period of time. Let's say 10 to 15 years. I think growth will do better. Do I think growth is going to do better over the next 5 years? Maybe not. Maybe not. And if you ask me in the next 2 years, I think value probably is going to do better, honestly. So I could be wrong. I could be right. Let's take a look now at the actual growth rates, annual growth rates. And so if you had $100,000 invested back when these portfolios were created, which is December of the year 2000. So the final balance of SPYG is $365,687. The final balance of SPYV is $390,127. So you have more money investing in the value than the growth. The CAGR, so the compound annual growth rate, 6.43%, 6.12%, being 6.12% for SPYG. Standard deviation. So you actually had more risk in the growth ETF than you did in the value ETF, even though the value ETF, you have more money at the end. And in terms of the worst drawdown during this whole time, they were both equally terrible. So negative 56.93% for SPYG, negative 53.68% for SPYV. You couldn't hide in 2008 basically in either of these. Here we're looking at a portfolio of using both SPYG and SPYV together, and I know everyone's going to want to know, like, hey, what if you just invest in both of them? What if you do half and half? Okay, what if we do half and half, or for one portfolio, and then the other portfolio we compare it just to the S&P 500? So I was kind of very a little shocked at the results that we see in this one. So SPYG, SPYV portfolio, this is portfolio 1, this is the blended portfolio. The blended portfolio underperforms just investing in the S&P 500. 393,174 if you invested in both of them, half in each, and then 442,754 if you had invested in just the S&P 500. This is going back until December 31st of the year 2000. So you actually did better in investing in the S&P 500 in this scenario. What if we actually change this up and let's go more recent times? Well, if we go back to the year 2010 till today, so you essentially did the same in this portfolio. Basically the growth way outperformed, the value underperformed, they kind of met in the middle, and you got the general S&P 500 return. At the end of the day, which one is better? Like I said, if I'm going to be taking a short-term look at this, I'd say SPYV is probably going to outperform. If I'm going a little longer term, I'm going SPYG for a longer term position. So that's all I have. Hope you liked it. If you did, subscribe, hit that like button, disclaimer right here, and see you in the next video.